Welcome to your video for USAR income statements. What does USAR stand for again? So it stands for Uniform System of Accounts for Restaurants. Restaurant income statement using the Uniform System of Accounts shows sales and costs of sales related to food and beverage and any other expenses related to the functioning of the restaurant. So it shows all your revenues, your prime costs, and all other expenses that you require to operate a restaurant. We follow USAR, the Uniform System of Accounts, to make sure that we are consistent from year to year for ourselves, so we can compare it to our historic statements. We can provide budgets using that same approach, and we can compare ourselves to industry standards, and lastly, our competition. So let's go through each one of these sections together. First, we'll always have revenues listed, and they will always be listed at the top. Top line revenue we'll refer to it as top line revenue when it's total sales before expenses. Okay? Different operations may report revenue in different ways. So what we mean by that is you'll see that for this example, it's divided by food and beverage. You may also see this divided into dining room, bar area, and takeout. You may see it divided by breakfast sales, lunch sales, dinner sales. This is up to the restaurant and the management team themselves, as long as it's consistent. Whichever approach they want to use is fine, as long as revenues are listed first, and you always have a subtotal for top line revenue. Total sales is what that is. Then we'll always have prime costs under the USAR format. Prime costs are total cost of sales and total labor expense. So remember that cost of sales is the amount paid for the food and beverage F&B used to create the revenues. So in order to sell food and beverage, you need to purchase food and beverage. That would be one of your biggest costs. The other one would be your labor. So this would be your management, your staff, and the difference between the two would probably be the fact that your management have salaries, while your staff, part-time staff, they all have an hourly. Okay? And then a lot of times you'll see benefits. Now, the reason why these are prime costs is because they represent a very big portion of the costs, expenses, that you have to take away from these revenues. That's number one. Number two, you have control over these. What I mean by that is, if you take control of your food and beverage costs, you can watch for any kind of inefficiencies. Make sure there's not too much waste. Make sure your plates are all consistent. For your staff, if it's not too busy, you can make sure that you cut some staff and you save on your part-time labor, on your hourly labor wages. So you have, as a manager, control over these costs. So it's in your best interest to keep an eye on them. So we always want to make sure that we keep an eye on our prime costs. So food, beverage, and labor for restaurants. The next section would be other controllable expenses. So those are other costs that a business has control over. So what managers can control. For a restaurant, you might see any kind of entertainment here. Well, once you book someone, you're paying them that price, but you can decide how much you're spending on your entertainment. You can decide how much you're spending on your marketing. Your utilities could be affected by how much you're using, whether or not you shut down everything at night. You can control that a bit more. Your administrative in general, you can control how much you're paying them. You can control how often you're getting your administration team to come in. Is it a part-time position? And repairs and maintenance, you can control that as well, as much as possible. So those would all be your other controllable expenses. You would then have a controllable income line. That would give you your subtotal to know how your controllable income is. So these are all your controllable expenses from your cost of sales, labor, and other controllable expenses. You want to make sure that you're controlling them to the best of your abilities as efficiently as possible to make sure that you're making the most controllable income as you possibly can. Because then you have your non-controllable expenses. These are expenses that do not fluctuate with the amount of sales. So they're fixed expenses. That means that no matter whether you sell $0 in sales or you sell $100 million in sales, it doesn't matter. You will always have to pay for your occupancy costs, and they will stay the same no matter what. You have no control over those expenses. So just to review, it will always be your revenues first, minus your cost of sales, and minus your payroll and benefits, which are together called your prime costs. You'll then take away your other controllable costs to find out your controllable income. And then from your controllable income, you will then deduct your non-controllable expenses, things you have no control, to find out your operating income. Your non-operating expenses may be your interest expense, anything like that you don't really need to operate, but it's there. You still have to account for it. And then you'll find your income before income tax. Remember, this will be either profit or loss at that point.